Here is the overview of today's gold market news. Gold price performance, price trends, and technical outlook. U.S. trade deficit soars as companies stockpile goods ahead of looming tariffs. U.S. consumer spending declines as inflation moderates, economic risks and tariffs influence on gold price. Global equity funds see record inflows amid rate cut expectations, trade war concerns influence on gold prices. Let's have a look at the latest gold price performance, price trends, and technical outlooks. Gold is approaching key support levels. The next lower target is the 38.2% Fibonacci retracement at $2,813. Additional support is identified around the prior trend high of $2,790 and $2,769, where the 50-day moving average of $2,769 is seen as a significant support level and aligns with the 50% Fibonacci retracement. A rising uptrend line near this level suggests it could act as strong support unless the trend line fails. Gold experienced a bearish retracement, dropping to a new low of $2,833 on Friday. A weekly breakdown occurred when gold fell below the 3-week low of $2,853, signaling a continuation of bearish pressure. Ending the week below this level further confirms the bearish trend. Gold is set to form a potentially monthly bearish shooting star candlestick pattern for February, signaling a weak monthly close. The low for February is $2,772, near the 50-day moving average, which could trigger a monthly breakdown if gold fails to recover. On the upside, the 20-day moving average at $2,896 is a key resistance level to watch. The area around last Tuesday's low of $2,888 could form a resistance zone, where gold might face bearish intraday reversal patterns. If the bearish pressure continues, gold could test lower price levels, potentially declining towards the $2,726 resistance from December. The overall trend is showing increasing selling pressure, suggesting a greater likelihood of testing these lower support levels before any correction completes. Moving on, let's look at why the U.S. trade deficit soars as companies stockpile goods ahead of looming tariffs. In January, the U.S. merchandise trade deficit surged to a record $153 billion, more than 25% higher than the previous month, driven by companies stockpiling foreign goods and metals in anticipation of new tariffs proposed by President Donald Trump. This surge greatly exceeded economists' predictions and contributed to increased imports of gold bullion, particularly from Europe to New York, as businesses sought to mitigate potential tariff impacts. This surge in imports, particularly from close trading partners like Canada, Mexico, China, and the EU, was driven by companies attempting to mitigate the impact of looming tariffs. Tariffs plans include 25% tariffs on EU products, additional 10% tariffs on China, and 25% tariffs on Canada and Mexico, which are set to take effect on March 4th. The impending tariff saw the U.S. goods trade deficit surge 25.6% in January, driven by an 11.9% increase in imports. This contributed to expectations of weak economic growth or even a potential contraction in the first quarter. Ports of Los Angeles and Long Beach recorded their busiest January on record, with the increase largely driven by retailers moving cargo in anticipation of tariffs on goods from China, Mexico, and Canada. Imports of photovoltaic panels and solar energy equipment saw a fourfold increase between December and January. The uptick in imports was seen across various goods, including industrial supplies up nearly 33%, consumer goods up by more than 8%, and surge in gold shipments into the U.S. The surge in gold bullion shipments, particularly from Europe to New York, are to avoid potential tariffs on bullion. The value of gold stored at the New York COMEX exchange surged by about $25 billion in January. Analysts expect this impact, driven by fears of tariffs on gold, to reverse relatively quickly. Next, here are the update on why U.S. consumer spending declines as inflation moderates, economic risks and tariffs weigh on gold price. Investors are closely monitoring the Personal Consumption Expenditures Price Index, with projections indicating a slight decrease in inflation for January. This data is pivotal as it influences expectations regarding Federal Reserve interest rate decisions, which in turn affect gold prices. U.S. consumer spending dropped 0.2% in January, marking the first decline in nearly 2 years and the biggest decrease in almost 4 years. This decline followed a strong 0.8% increase in December 2024. The fall was attributed to reduced spending on goods, which dropped 1.2% and was particularly affected by motor vehicles, recreational goods, and food and beverages. The Personal Consumption Expenditures Price Index rose 0.3% in January, matching December's gain. Year-over-year inflation moderated slightly, with the Personal Consumption Expenditures Index increasing by 2.5% in January, down from 2.6% in December. Core inflation, excluding food and energy, rose by 0.3% in January, with a year-over-year increase of 2.6%, down from 2.9% in December. The Atlanta Federal Reserve revised its first quarter GDP estimate to a contraction of 1.5%, down from a previous 2.3% growth forecast. Financial markets expect the Federal Reserve to resume interest rate cuts in June, after a pause in January, as inflation moderates and economic risks grow due to tariffs. Consumer inflation expectations surged in February amid concerns over the impact of tariffs. The rise in tariffs, particularly on imports from China, Mexico, and Canada, is expected to push prices higher, as businesses pass on the increased costs to consumers. President Trump's administrative policies is having an impact on gold prices. The active reduction federal spending, particularly through cuts to agencies like the U.S. Agency for International Development, is contributing to economic uncertainty and are expected to have spillover effects on consumer and business confidence. Moving on, let's look at the causes for global equity funds to see record inflows amid rate cut expectations. Trade war concerns weigh on gold prices. Anticipation of future rate cuts, driven by weak economic data, has led to significant inflows into global equity funds, amounting to $28.3 billion in the week ending February 26, 2025. U.S. equity funds saw significant inflows of $19.71 billion, marking the largest weekly inflow in 9 weeks. European and Asian equity funds also experienced inflows of $4.33 billion and $3.25 billion, respectively. This shift in investment flows reflects market sentiment regarding monetary policy adjustments and has implications for gold prices, as changes in interest rates can influence the opportunity cost of holding non-yielding assets like gold. Despite strong inflows, global markets face steep losses and faced uncertainty due to growing concerns and tensions arising over trade wars, further exacerbated by President Trump's announcement of new tariffs, effective upcoming Tuesday.